please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's move forward and say hello to Girish Pai, Head of Research at Nirmal Bang. He's joining in to talk about the fundamentals of the market and, of course, his view on how the IT earnings have looked so far. Girish, since that's a space close to your heart, you've tracked it for so many years. Let me start by getting a sense on HCL Tech. And what do you think, is this market disappointment justified with their 9.5 to 11.5% constant currency guidance for next year?
Yeah, I think the street and I have been disappointed by the organic growth kind of indicated by the company. So the 9.5 to 11.5% growth, if you take out the couple of acquisitions that the company has done in the beginning of the quarter, if you take that out, that's about 400 basis points. I think the organic growth kind of indicated is between 5.5 to 7.5%, which is probably at par with what the company's done in FY18, and probably not an uptick over that growth that we've seen in the past. So that is probably a source of disappointment. I don't know whether there's any further inorganic elements to the guidance that has been given, but just going by the two acquisitions that they've done in April, that's a sense I have. 5.5 to 7.5 seems to be the organic growth they're kind of indicating. Which may be a tad lower than what the street was anticipating in terms of growth, because the commentary from the management was fairly positive when the quarter results were put out in January.
Girish, hi, morning. The other space which is actually in focus is the entire aviation space, not only because of the management changes at Interglobe, but also because ATF prices have now been hiked by 6.5% and separately we do have the numbers coming out today as well. There's a lot of news which is expected probably, but your thoughts in terms of whether the aviation space has lost a little bit of its sheen?
No, we don't track aviation, so I wouldn't be in a position to comment on aviation specifically.
Okay. And what about oil and gas?
Yes, so oil and gas, the OMC space is something that we've been cautious on for a while. Basically, we're talking of HPBP, IOC. That space we've been cautious on because our analyst view has been that over the last 5 or 6 years, the fairly strong performance of the stocks have been driven by a few factors. One has been the GRMs have kind of been on the up. That has been compounding at a fairly good clip. The fact that the petrol product prices have been kind of freed up, that's been the other factor driving growth. The third factor has been CapEx has been very muted, which has resulted in both depreciation and interest costs growth being very muted. So that has driven fairly strong earnings growth for these companies, which has driven the stock prices also up. So the earnings growth for some of these companies have been like 30-35% compounded over the last many years. We see that situation kind of coming to an end. We think the GRMs have kind of peaked out. We think that the companies are on the anvil of a fairly sizable capex from here on, which will lead to both depreciation as well as interest costs going up, which would mean that the earnings growth for these companies are going to be fairly muted. On top of that, I think lately over the last maybe couple of months, the worry has been more in terms of whether these companies are going to go back to the subsidy sharing regime, so to speak, that they kind of went through in probably like 7-8 years back, where there was a under recovery mechanism where this was split up between the oil marketing companies, upstream companies and the government. And the fear now is that probably the government will not be willing to take the hit considering the fiscal situation it is in. So it would be a situation if crude goes to 75 or remains there or goes to 80, I think the under recoveries will have to be split up between the upstream and the downstream, which is your OMC. So that's why we are fairly cautious on this particular space of the market.
Okay, fair enough. I just want to talk to you about some of the NBFC earnings, Girish, that have come through. Now, which part of the NBFC universe would you play? Because companies have come out with some great growth numbers. I mean, DHFL 80% up on disbursements. CV financiers have come out with some amazing numbers as well. What would you be comfortable playing?
So one has to be, specific in terms of the stocks that one picks. So in this particular space, we look at only two segments. One is the housing finance, the other is the gold finance space. Gold finance, we're very comfortable. We think the yields there are going to be fairly strong. Both the companies, Muthoot and Manappuram, have changed their business model, whereby some of the losses they were incurring because of the fact of the fall of gold price has all been kind of nullified. This has happened over the last couple of years. So we think that these companies have got pricing power, and we think that these are two good areas, good stocks to focus on. Within the housing finance space, we obviously like PNB Housing Finance and Canfin Homes, largely because of the fact that they've got much lower cost of funds. So their cost of funds is very close to what HDFC, the industry leader, has got. So I think the cost of funds situation is a very critical element to the housing finance industry, considering that the pricing aspect isn't very free in one sense. It's very constrained by what the banks price their loans at. So the cost of funds is very critical, where we feel that PNB and Canfin Homes have got fairly low cost of funds, and we think that these are potentially the winners in the housing finance market along with HDFC.